All right. Well, good morning, good afternoon, or good evening, depending where you are or when you're watching this, if you're watching the recording. Welcome to I think this is day 15 of our class of GBS 261. So today's session, we're kind of actually going to finish up with the presentation itself. We see some of that on screen right now. But before we do, okay, I just ran, before we started today's question session, we just ran a few, just basically kind of off the cuff, gave you some quizzes here, some quizzes on some stuff. Did pretty well, by the way, overall. Before we go, let's go ahead and start a Kahoot. So let me go ahead and bring this up. I'll need a moment to do so. Okay, getting started here. All right, ready to join? And your game pin is 3694311. All right, people loading in here. 1, 2, 3, 4, 5, 6, 7. Okay, probably one more. Okay, missing anybody? 4, 5, 6, 7. Ah, there we go. Okay, that's 8 folks here, and let's 8 in our class. I think we're ready. Let's play Family Feud. And our first question is, what does the mortality guarantee of a variable annuity ensure? A, that payments will continue for the life of the annuitant. B, that total payments of the annuitant's life will meet a specific minimum. 3, that payments will continue for the annuitant's life expectancy. Or D, that each monthly payment will meet a specific minimum. That is the mortality guarantee, right? That the payments will continue for life. That's what an annuity is. It's a contract with an insurance company in which someone will deposit money into an annuity, and there are certain tax benefits for it. And then the insurance company guarantees it will distribute that money over a period of time, over the life of the contract. The life of the contract is basically the life of the person. The mortality guarantee, well, that's that cost of coverage. That's that cost of that lifetime income guarantee. Because keep in mind, when they say lifetime income, that means that no matter how long somebody lives, the insurance company will continue to make regular payments. And that's true even if their annuity runs out of money, the insurance company guarantees lifetime payment. Well, that kind of coverage, again, does cost, and that's called the mortality guarantee, and that's part of the cost of having an annuity. The payments will continue for the annuitant's life expect. Let me see. Hold on a second. The payments will continue for the life of the annuitant, or that payments will continue for the annuitant's life expectancy. Oh no, not life expectancy. Not life expectancy, right? It's actual life of the annuitant. Life expectancy is based on the actuarial tables. Okay, what the mortality tables expect how long someone will live. No, they will make payments for life. Now, the payment schedule is going to be based on the assumptions of the mortality tables, right? So they'll sort of expect, if they expect you to live for so many years, their payments are based on that. But if you live longer than that, you'll still continue getting payments for life. All right. Does that make sense? Does anybody that says you're not totally 100% clear? If it isn't, please let me know. All right. Now, by the way, D is not true. That monthly payments will meet a specific minimum. As a variable annuity, right, the payments fluctuate based on the performance of the investments because the policyholder picks the investments. So it's based on how the investments perform compared to how they expected them to perform. So no, it's not a specific minimum. Okay. What type of annuity will have a specific minimum? That would be a fixed annuity. Is yellow based on a guess of the annuitant's lifespan? It is based on a guess, yes. Yes, okay. Okay, that is based on that guess. Okay, thanks, Karina, you bet. All right, let's see how we did here. So All right, so Kimberly and Alexis putting some points up. Let's check our next one. Which of the following issues only common stock? A, a face amount certificate company. B, an equity unit investment trust. C, a closed-end management investment company. D, an open-end management investment. Only common stock is an open-end fund or open-end investment company. Right. So then what's the popular name for an open-end management company? Mutual fund. So now I'm only talking about this is what they issue, what they sell to investors in order to raise capital. So everyone who buys into a mutual fund basically owns a piece of the investment portfolio. All investors are common stockholders, so no one investor is going to have an experience different from any other investor. When the investments in the portfolio go up or down, it goes up and down for everybody the same. Closed-end funds, just like any other corporation, can issue common stock, preferred stock, or bonds. Now, again, this is what they issue to raise money. I'm not talking about what do they invest with. Once they've raised money, what do they buy or invest in? Both open and closed-end funds can invest in any security that meets their investment objectives. They could buy common stock, preferred stock, bonds, options, but an open fund only issues common stock. All right, an equity unit investment trust, they're called shares of beneficial interest, or SBIs. Very similar, by the way, to common stock, but technically it's called shares of beneficial interest. All right, let's see how we do here. All right, Hannah's moving up, and Ashley got some points on. Mutual fund shares are required to be priced at least A, hourly, B, once per business day, C, continuously throughout the day, D, at each day at the opening of the market. Yes, exactly. Mutual fund shares once per day, more precisely, at the end of the day, right? They're based on closing price, not opening price. The close of market, which is 4 p.m. Eastern time. Why 4 p.m. Eastern? That's when the New York Stock Exchange closes. So at 4 p.m., the mutual fund has to basically go in and recalculate the value of all its investment holdings, marked to market. That's how they describe it, marked to market. And the assets are revalued at the end of every day by that day's closing prices, and they come up with a closing net asset value for that day. And then all trades for that day are based on that day's closing net asset value. Never opening for mutual funds, always closing. Which type of fund, right, is priced continuously through the day? Can you tell me? This ETF? Actually, that is true, come to think of it. All right, but I was actually thinking about closed end. But yeah, you're right, Kimberly. ETF also, because it trades like a stock. So they look, exchange traded funds are categorized as open end funds, but they look and act like closed end funds. All right. Hey, both of you did a great job. Thanks so much. Okay. All right, Alexis and Ashley moving on up. Let's try our next one. Which of the following prospectus must be provided no later than the confirmation of the sale? A, summary prospectus. B, statutory prospectus. C, Rule 498 prospectus. Or D, statement of additional information. All right, kind of all over the place here, but the one that has to be provided no later than the confirmation of the sale, the statutory or full prospectus. Yeah, that's basically the final prospectus, and that contains everything that any potential investor needs to know. And they need to receive that no later than the confirmation. Now, the confirmation means they've already bought the mutual fund, haven't they? Okay, they've already placed their order. Now they get the confirmation of it. So they need the prospectus by that time. Not before. They don't necessarily have to have it before. It's fine if they do, but they don't have to because there's a summary prospectus that they could have. And the summary prospectus contains, right, well, it's a pretty short one. It's like 6 or 8 pages, but it's considered to contain enough information for someone to make an informed investment decision. And the summary prospectus must also include ways on how to acquire the statutory or the full prospectus. whether to call and who to call and ask for one, or where to download one. And if they can download it, as far as regulators are concerned, as if they have the availability to get it, it's as good as actually accessing it. The 498 prospectus, that is the one that is the for the tombstone ad, is basically it's nothing more than a sales brochure and who to call for more information. So the 498 prospectus does not have enough information to make informed decisions. It is not, therefore, a disclosure document. The Statement of Additional Information, or SAI, contains a bunch of supplemental detail about the operations and the expenses of the mutual fund. So it is available on request. It is not required for someone to have one, only on request. Okay, hey, Ashley's 3 in a row and moving ahead. Let's try our next one. Which type of shares allow the investor to buy and sell the shares at NAV and have 12b1 fees of 0.25% or less? A, no load. B, Class C shares. C, Class B shares. Or A, Class A shares. No load funds to buy and sell at net asset value, and the maximum 12b1 fee is 0.25% per year, or 0.25% a year. You can tell, right? To buy and sell at net asset value. See, normally investors buy at public offering price, which is the net asset value, with the sales charge added on top of it. The relationship between the NAV and the POP is like wholesale and retail. 12b1 to be a no load fund, at least be able to call itself a no load fund. Maximum 12b1 fee is 0.25% a year. Now remember, 12b1 fees, they cover the cost of marketing and distribution. Class C shares, all right, true, they allow you to buy and sell at net asset value, but they have a 12b1 fee higher than 0.25%. In fact, it's usually like 1% per year. So they pay their sales charge every year as long as they hold it. So if a fund charges more than 0.25% in 12b1 fees, it cannot call itself or advertise as a no-load fund. They actually become Class C shares at that point. Class B shares also buy and sell at net asset value, but they also have a 12b1 fee more than 0.25%. Right? There's not a limit on it. But the Class B shares, that's the one with the back-end sales charge or the back-end load. Right? That means they pay a sales charge going out rather than going in. All right, Kimberly moving into the lead. Hannah Lisha moving up. Very nice. Let's go our next here. Which of the following would you expect to have the lowest expense ratio? A, the ABC Corporate Bond Fund, B, the RS Stock Income Fund, C, the M&O Small Cap Fund, or D, the XYZ Risk. Right, this one was kind of difficult, right? The lowest expense ratio, in this case, in exploiting all these funds, they're not, there was no indication about things like 12b1 fees, didn't say what share classes they were, didn't say anything about administrative fees. The only difference now that sets these apart, the management fee. Which one would have the lowest management fee? Now, my first thought might have been if you look for an index fund, those are known for having low management fees, but that wasn't one of our choices. If you consider this, the more actively a fund is managed, the more work that the fund manager is doing, then the higher the management fees. Now, for example, we would tend to expect higher management fees for a small cap fund. How come? Because, well, there are more small size companies than there are large size companies. So the fund manager's got to do more digging to figure out which stocks they want to invest in. An aggressive growth fund also is very heavily managed. The investment manager is going to be deeply invested in aggressive growth. A stock income fund, maybe so-so about the fund manager's activity on that. I mean, they're still going to have to do some research, but as a stock income fund, they're mostly focused on the dividend. The one where the fund manager is probably going to do the least amount of work is a corporate bond fund. Because once they picked out their corporate bonds, they're not really going to trade them a whole lot. Bond investors tend to be just buy and hold. So they won't do a whole lot of trading for a corporate bond fund. That's the one I think therefore has the lowest expense ratio. Yeah, this was a difficult question. All right, but Alexis moving on to second place. Which of these investment companies trade in the secondary market? A. Unit investment trusts. B. Closed-end funds. C. Face amount certificates. Or D. Open-end funds. Nicely done. Yes, closed-end funds trade secondary market. Just like any other corporation, they'll do a one-time initial public offering, sell their shares in stock, a fixed number of shares, sell them to ground floor investors. They'll do an initial public offering, and then once the shares are all sold out, that's all there are. So then they're listed and traded on a stock exchange or possibly over the counter, and they're traded just like any other stock, secondary market between investors. So the price fluctuates throughout the day, and the price at any time is based on supply and demand at that particular moment. All the other three, primary market only. There is no trading between investors of these other types of investment companies. Ashley moving up. Okay, let's take this one. A variable annuity's investment return each month is based on A. The contract stated guaranteed monthly return. B. The assumed interest rate stated in the contract. C. The performance of the insurance company's general account. D. The performance of the separate account. This was a difficult one too. Okay, the variable annuity's investment return is based on the performance of the separate account. Now remember, with any type of variable product, right, it's the policy owner who picks the investments. No guarantees on the rate of return anymore from the insurance company. Everything depends on how well their investments do. So now the risk is on the policy owner. All right, now policy owners figure that in the long run, it's a risk that'll pay off. Okay, so it'll be based on the performance of the separate account, not the general account. The general account holds the money on the policies that the insurance company has guaranteed to pay. Since the insurance company does not guarantee the returns on annuities of variable products, right? That way the money must be kept separated, right? Have to separate away from the general account. After all, if those investments crash, you can't have it affect, right, the policies in which they've guaranteed. In the general account, the insurance company has all the market risk here, the investment risk, because they have promised to deliver a certain rate of return. So they invest that money very safely and securely, but also doesn't pay a whole lot. There is no guaranteed monthly return in a variable contract. Is it based on the assumed interest rate? Almost. The investment return is based on the performance. The monthly payments is going to be based on the actual rate of return of the separate account compared to the assumed interest rate. Basically, what the investments turn out to be versus what they thought it would be. Okay. Again, if you need any detail about that, if you need some more help with that, please feel free, unmute or type me a message. Alexis moves into the lead and 3 in a row. A diversified fund charging 0.4% of net assets per year as a 12b1 fee may not say the fund A will have a calculated, fully disclosed expense ratio. B is a no-load fund. C has a diversified portfolio with a stated investment objective. Or D will pay its investment advisor a specified percentage of funds and remains. We mentioned this a little bit earlier, right? If they charge 0.4% of net assets per year of a 12b1 fee, right? If it's more than 0.25%, it may not call itself or advertise as a no-load fund. Okay, like I said, it becomes Class C shares at the point. We can say, though, they can say it is a diversified portfolio. In fact, it's a diversified growth fund and does have a stated investment objectives. In fact, all investment companies must have a stated investment objective, according to the SEC. They say this is the goal and purpose of this fund. That way, investors can pick the fund that's in line with their own investment objectives. It's like making sure you get on the right bus. Okay. So yeah, they cannot say it's a no-load fund if they charge more than 0.25% of assets in a 12b1 fee. Alexis is 4 in a row. Alicia moves on the board. Okay. Which of the following investment companies terminates business on a predetermined date? A. Mutual fund. B. Hedge fund. C. Fixed unit investment trust. Or D. Non-fixed unit investment trust. It is right, a fixed UIT. Yes. Okay. So first off, kind of a little hint here, but I've made an observation. If two of the four answer choices are kind of opposites of each other, there seems to be a better than average chance it's one of those two. Not always, of course, but better than average. All right. Since a unit investment trust is organized as a trust, yes, it must have a termination date, right? A date in which the trust is dissolved. And at that point, the board of trustees will sell off or liquidate whatever investments the trust still holds and send a check to investors. Investors can then have a choice, reinvest it back into the UIT, right back into the next UIT in the series, because when one terminates, another one's created, or just take the money and run. Now, a non-fixed UIT, see, because it's not fixed, that means it really invests in mutual funds, or so it's basically a basket of mutual funds. Variable contracts, like variable life and annuities, use non-fixed UITs. A mutual fund is organized as a corporation. So as a corporation, it can conceivably last forever. A hedge fund, all right, hedge funds are organized as private placements, and they should have some sort of termination date to them, but they don't always. But a UIT, fixed UIT, yes, always does, always must. That's why, by the way, a lot of them are organized as bond UITs. They buy a big basket of bonds. And when the very last bond that they bought matures, that's the date to dissolve the trust. Alexis has a winning streak of 5 in a row, and we got one more. Class B mutual fund shares are also known as A. Deferred load shares, B. Contingent deferred shares, C. Back-end load shares, or D. Partially loaded shares. That's it. Good job. Class B shares is the back-end load or back-end sales charge. If it helps you remember, Class B for back-end, which means instead of they're paying a sales charge on the way in, going in, a front-end load, Class A shares, they're subject to a sliding scale sales charge when they redeem their shares on the way out. And the sales charge they charge becomes smaller and smaller the longer they hold it, until after some years, like 6, 7, 8 years, the sales charge runs down to zero. And then what happens is Class B shares convert over to Class A shares without ever paying a sales charge. And what's so great about Class A shares? Lower operating costs, lower expenses. Choice B, contingent deferred shares, sounds so close because Class B funds are subject to a contingent deferred sales charge, but they're not called contingent deferred shares. They're called back-end load. Okay, deferred load, not quite. Partially loaded, there's no such thing as a partially loaded shares. Okay. All right, very good. Let's see who's on the podium. In third place, bronze medal, is Kimberly. In second place, silver medal is Ashley. And in first place, gold medal and Olympic champion, Alexa. All right, fantastic. Hey, big old cheers and confetti and applause and thumbs up. All right, fantastic, everyone. Okay, anything from that maybe you just like to get more detail about? Is there any part of that feels not totally clear? Let me go ahead and I'll pause the video here. Okay, welcome back. So basically, we're gonna kind of close out our actual the formal lecture part of it here. All right, so picking up from last Monday, where we talked about economics, we did mention things about how to measure the overall stock market, and that they do that with a market index or market averages. And what it's a mathematical construction in which they use a representative sampling. So they pick certain samples and they use that as a measure or barometer of the overall market index. Now, the one you'll hear about on TV usually is the Dow Jones Industrial Average. How did the stock market do today? The Dow Jones Industrial Average was up or down or whatever it was today. All right, so the Dow Industrials. Now, why is that one so commonly quoted? How come that's the big one? Well, Who's the publisher of the Wall Street Journal? Right? Dow Jones and Company, or at least it was. All right, so that's where it comes from. That's why it gets such big press, because of the Wall Street Journal. Now, the thing about the Dow Jones Industrial Average, right? It is a basket of stocks that they use to measure the market and the economy. But the thing is, it's only consists of 30 stocks. That's right, just 30 stocks. Now, they're very carefully chosen 30 stocks, and they're very large, not just large cap, but like the biggest mega cap size corporations. Right? These are who's in the Dow Industrials, right? Like McDonald's. Who else? I'm trying to remember now. I know that IBM is in there, Walmart is in there. I think Salesforce in there. I think that was the most recent addition. Whereas sometimes they change which 30 stocks they cover. Like General Electric, for example. Well, that was in the Dow Industrials for like over 100 years. Well, not until recently. Well, because General Electric has maybe seen better days. Now, even though it's only 30 stocks, nevertheless, those 30 companies represent a huge portion of the capitalization of the stock market. So it is not really a bad measurement of the stock market, but it is just a representative 30 stocks. So, so usually when they talk about the stock market or the average stock market index or how's the market doing, the test usually talks about the Standard & Poor's 500. Okay, the S&P 500 index. So Standard & Poor's is a research company, tracks the price and performance of 500 of the largest, most widely held U.S. corporations, and uses that as a barometer or measure of the overall stock market, particularly for large cap stocks, right? Big size company stocks. So if you have a mutual fund that invests in large company, large cap stocks, you'll probably measure it or benchmark it against the S&P 500. Did your mutual fund outperform or underperform the S&P 500? So that's what they'll use as a measuring stick usually. Okay, whether the actual performance was better or worse, they usually turn to the S&P 500 for large company stocks. Now, if you want to measure small cap stocks, the usual there is the Russell 2000 index. So Russell 2000 measures, I don't think the number 2000 is actually literal, but it's 2000 small size companies, small cap stocks. Now, if your mutual fund invests in small cap stocks, you'll probably benchmark it or measure it against the Russell 2000. How did your fund do? Did it be better or worse than average as measured by the Russell 2000? NASDAQ 100 is also one that's often used. It is the 100 largest non-financial companies that are NASDAQ listed. So we might use that also as a measure of that market, but that market tends to be technology heavy, right? Tech stocks tend to weigh on the NASDAQ more so than the other markets. Okay. The one that they use as the broadest base market index is the Wilshire 5000. That's designed to be the total market index. The number 5,000 I know is not literal. I think it's more like 3,000 something. But they still call it the Wilshire 5000. Maybe at one point it was 5,000. Well, anyway, this is a measurement of large cap, mid cap, small cap stocks that trade on New York Stock Exchange, the American Stock Exchange, and NASDAQ. So that's a total market index. So if you're measuring a total fund or maybe a whole portfolio, you might measure it, benchmark it against the Wilshire 5000. For example, I benchmark my 401k overall because my 401k has got large cap, small cap, mid cap stock funds in it. So I benchmark it using the Wilshire as the total market index. This brings up something here because, okay, so the New York Stock Exchange, now the thing is, okay, it was originally called the American Stock Exchange, or Amex for short. Then it got acquired by the New York Stock Exchange and changed its name to NYSE Market, right? Abbreviated MKT. It changed its name again to be called NYSE American. Okay, and it basically folded into the New York Stock Exchange. The American Stock Exchange used to have its own building, not too far away from the New York Stock Exchange. But once it got acquired, it basically became one of the trading desks, one of those horseshoe-shaped trading desks on the floor of the New York Stock Exchange, and it focuses on more small-sized companies, where the New York Stock Exchange is big-sized companies. Okay, and Nasdaq is considered to be it's like the top tier of the over-the-counter market, but it is considered to be and is listed with the Securities and Exchange Commission as a stock exchange. So we can say things are listed Nasdaq. Now, of course, the one things that are not listed, okay, the unlisted securities would be considered OTC, over-the-counter, non-NASDAQ. right, that don't qualify for NASDAQ listing. All right, I'm going to try this here. I'm going to throw this out, but I'll give total brownie points to anyone who can answer this question without looking it up. All right, but before it became a stock exchange and just sort of changed its name to NASDAQ as a brand name, NASDAQ was an acronym. That's often why you see it in all caps. Can anyone tell me what NASDAQ stood for? What was the acronym for? Anybody give a shot at that? Okay, I wouldn't worry about it too much. I don't think it'll be a testable topic, but I'm just kind of curious. Okay, well, Karina's not sure, kind of thinking about it here. Got the thinking emoji. All right, anyone? And okay, Colby, National Account Securities Department in quotes. Not quite, not quite. Getting there. Some of them were, or some of those letters did match up. Okay. Anyone else got a guess, or should I just give it to you? Okay. NASDAQ. Okay, National Association. Okay, Karina, you got the first two. Okay. The National Association of Securities Deposits, not deposits, not department, but it is secure. Amy, right? Securities dealers. Okay. Now, what about the other two letters? Okay. I'll give it to you if no one else can think of it. And quotes, quotes. Okay. The A is not stand for and. Q, all right. Quotes is close but not exact. Okay. All right. I'll give it to you in. Oh, thought I heard something. Okay, let's close this out. National Association of Securities Dealers Automated Quotation System. Okay, that's what it stood for. Okay, Karina gives you a shocked face. Yes, that's what it stood for. On National Association of Securities Dealers Automated Quotation System. Now remember, the predecessor to FINRA, right, was the National Association of Securities Dealers, the NASD, right? It created a computerized quotation system for the top tier level of over-the-counter stocks, right? So I mean, like like Microsoft, for example, Amgen, Cisco Systems, okay, as a way to give quotes on them. Now they don't really want to be in the quoting business anymore. They want to be basically industry regulators. So Nasdaq is just basically now a brand name rather than an acronym, but that's what it stood for. Okay, all right, and you'll really impress them at the interview if you can say what Nasdaq stood for. Okay, risk, of course. Now, all investments involve risk, and we can say that because there are many different types of risks. We want to be familiar with these different types of risks so we can identify them on a test question and maybe even identify ways to manage those risks. You can't entirely eliminate them, but they can be managed. So in some cases, you're trading one risk for another. Like, for example, government bonds. Super safe, government guaranteed, virtually zero default risk, but because they're so safe, right, they have a very low interest rate. And now, right, you've got inflation risk, the risk that the interest rate is so low it doesn't keep up with the rate of inflation. All right, now risk can be divided into two major categories as systematic and non-systematic risk. And a systematic risk is a risk that's inherent to the system. It is kind of part and parcel of having those types of investments. Those are the risks that affect the entire market for those investments. And it does not help to diversify away from systematic risks. All investments of that type face that risk. Market risk is a systematic risk, okay, because if the Dow Jones Industrials are down 1,200 points, you're experiencing some market risk, right? Whether it's stock market, bond market, real estate market, gold market, beanie baby market, whatever it is, okay? Those are market risks that are kind of inherent to it. You're kind of at the mercy of it. Doesn't help to diversify it. Or there are some more specific categories of systematic risk that describe, well, what specific cause, right, affects the entire market, like interest rate risk. If interest rates go up, the market price of bonds go down. And that's true for all bonds. Also preferred stocks, since they're fixed income investments too, because they have locked in rates, but the interest rates are changing and they're going up, and your bonds don't look as attractive anymore. Okay, it doesn't help to diversify. It's true for a bond fund. All the bonds, or it's just a matter of degree sometimes. Inflation risk, of course, I just talked about that, right? Right, the interest rate does not meet the inflation rate. I think I probably sold this here, right? People tell me that they're happy making 2% on their investments because they know it's safe. Thing is, they're making 2%, but the inflation rate is 3%, not really coming out ahead. So first off, what can you do about managing inflation risk? There are ways, of course, to hedge inflation risks. You can, for example, buy puts. Now, we know if you buy puts on an individual stock, you can sell your stock at a fixed price in case it goes down. How can you do that, let's say, with a mutual fund, though? You can hedge that with a buying put options, let's say, on a market index, like on the S&P 500 or the S&P 100. So, all right, so if the market goes down, yeah, your mutual funds go down too, but your put options on the overall market go up. So while these go down, they go up, and to some extent anyway, it offsets your risk. Or another way you can offset the risk is with inverse ETFs, inverse exchange traded funds. Inverse means opposite. So these are the exchange traded funds that they go opposite direction of the market. If the market goes down, the value of inverse ETFs goes up. And people could use that as a hedge against, let's say, their existing mutual fund portfolio. The market's down, their mutual funds go down too, but their inverse ETFs go up, and to some extent, it offsets their risk. So those are ways you can manage the systematic risk, and the way so you can also spread it around through asset allocation. Asset allocation is basically someone's master plan on how they spread around their money in the different investment categories. What percent goes where? Now, for the test anyway, there are three distinct asset classes. They are stocks or equities, bonds or debt, and money market securities. Okay, money market securities, which are considered cash or cash equivalents. So those are our three major categories, at least for the test. And you're thinking, well, what about gold? Okay, what about real estate? Okay, yeah, could be asset classes too, but for now, okay, stocks, bonds, money market securities, and someone will maybe work with their broker dealer, with their registered rep, okay, the kind of job you might have, right, and helping to figure out what's their ideal mix. It'll be based on things like their goals and their objectives. It'll be based on things like how much risk, their risk tolerance, how much risk are they able or willing to take, time horizon, how much time do they have before they need their money. So now here's something that can kind of help you out with these kind of questions. What asset allocation would you recommend for somebody? Now, this is not like a rule. It's not like a testable topic, just something to give you a little guidance in these kind of questions. So if someone's, especially if it's a retirement goal, if you take 100% minus somebody's age, that would give you their percent in stocks. So someone who's 40 years old would be 60% in stocks and the other 40% in bonds and cash. Someone who's 70 years old would be 30% in stocks. Now, that's, like I said, that's not like a rule or anything, just something to give you a little guidance in that. From that, you can sort of adjust that depending on someone's risk tolerance, right? If they're aggressive investors, you can increase the investments, the percentage. If they're conservative investors, right, you decrease that percentage. And then from there, you look at your four possible answer choices and see which one seems to come closest. So that's the concept here about asset allocation. You spread around the investment categories, you spread around the systematic risks. Now, the non-systematic risks are risks that are individual to each particular investment, to a particular type of to a particular industry, a particular company, a particular investment category. So therefore, you can spread out those risks by diversification, by diversifying your portfolio, and that's where mutual funds come in. So your asset allocation would be how much you percent in stocks and bonds. Then your non-systematic risk is diversifying by buying a stock fund and a bond fund and a money market fund and maybe other categories too. And you can start drawing finer distinctions, by the way. So some of the distinctions in stocks, for example, they might define as either large cap, mid cap, or small cap, or domestic or foreign. Other ways to diversify a portfolio, right, with different by spreading around that way. Bonds, you can diversify that with corporate bonds, treasury bonds, municipal bonds. Okay? So those are other ways you can start drawing finer distinctions. So the non-systematic risks, those can be spread out because it's the idea, right? You put all your money into the bonds of one single company, and that company goes out of business. Well, if they go out of business, you're out of business too. Okay, because you've had all your money with them, and they just went under. You put your money into a bond fund where you've got hundreds of bonds in different companies in different industries, maybe even different areas, parts of the country. All right, now you spread it around, and okay, if a few of them go out of business, hundreds more are still working. So you spread out the effect of the non-systematic risks. Okay, can't totally eliminate them, but you can spread it around where it doesn't impact you, at least not so much. Okay, it doesn't. At least you're still working. You're still in business. Okay, now a way you can measure risk. See, risk is uncertainty. That's what they mean by risk. Now, of course, if you think of risk, you're probably the first thing you think of would be capital risk, which is you put your investment capital into an investment and it goes down. That's probably the first thing you think of. But think of risk as being a level of uncertainty, and that uncertainty can be measured. We can put a number on risk by measuring the volatility of an investment. Volatility refers to the size and frequency of up and down price swings. So the more volatile something is, the bigger the up and down price swings that has, and therefore the greater level of uncertainty. So a stock like, I don't know, Tesla, for example. Let me see if I can kind of draw something for you here. Hang on. Um, Hang on a second. No, it won't let me do it. Okay. I was trying to use the annotation tools, the drawing tools here, but it doesn't let me do it. Okay, but anyway, a stock like Procter & Gamble, right, doesn't move a whole lot, right? A boring old soap company. So not very volatile, therefore not a lot of risk to it. Still some risk, but not very much risk comparatively. A stock like Tesla, however, now that's got a lot of volatility. That's got a lot of up and down to it. That's a very high risk stock. So the way we measure it is a measurement called beta. Beta is a relative measure of market volatility based on a benchmark of a market index. And so if you're talking about stocks, they'll usually benchmark against the S&P 500. By definition, the S&P 500, or what they're using as a baseline, has a beta equal to 1.0. That's by definition. So the beta of an individual investment is going to be greater than or less than 1.0, depending on the volatility of the stock. So as an example, a stock like Tesla, okay, a stock like Tesla, for example, I'm trying to get this on screen here, hold on. A stock like Tesla, okay, that's like a beta of like 1.8. So what that means is it is 80% more volatile than the overall market, right? Then it's benchmarked the S&P 500. So if the market's up like, 10%, we'll expect Tesla to be up 80% more, like 18%. Okay, right? However, if the market's down, we expect Tesla to be down 80% more than the overall market. So that's a much bigger up and down volatility, a much more broad range here of how it can go up or down. Whereas a soap company like Procter & Gamble, that might have a beta of like 0.75. Okay, meaning it's 75% of the volatility over the S&P 500. It helps if I can spell, right? Volatility of the S&P 500. All right. So if the market's up, right, we expect Procter & Gamble to be up just 75% as much. On the other hand, if the market's down, we expect Procter & Gamble to be down 75% as much. So not as volatile, therefore a lower level of risk. Now, of course, the higher the level of risk, the greater the expected return that you expect to receive. So you might compare the actual return versus its expected return to see if it's a risk actually worth taking. So if the beta is greater than 1.0, it is more volatile than the overall market. And if it's less than 1.0, it is less volatile and therefore has less volatility than the overall market. So you give an idea, well, which one do you get for what type of investor, right? An aggressive investor would like a high beta stock. A low risk investor, a conservative investor, would prefer a low beta stock. Now, by the way, a negative beta, okay, negative beta would go the opposite direction of the overall market. Let me write that out. Opposite the overall market. Okay, now as you might imagine, there are not too many things that would have a expected negative beta, but that could be something that goes counter to the overall market, as for example, mining stocks, right? Because when the market's down, investors start to flock towards things that are safer, like gold. So the price of gold starts going up. If the price of gold goes up, then the profits of mining companies start going up. And so people might start buying gold companies as a substitute for actually buying gold or silver. So they would have a direction that's opposite the overall market. So they're kind of counter the overall market. There is a measurement called alpha, which is the actual return compared to expected return, which will be based on beta. So a portfolio, especially like a mutual fund, we might look at a fund's alpha, which is the rate of return compared to its expected return. So how well is the fund manager doing? Are they making better than average decisions, for example? So, and we're looking at an alpha, if it has a positive alpha, that's good. That means it's performing better than its expected rate of return based on the beta, right on its investment category. If it has a negative alpha, however, well, that's bad. That means this fund is doing worse than expected based on its investment category, based on its beta. So we can use that as a way to measure or evaluate a mutual fund based on its alpha. So those are some things you can use. All right, so in terms of now, our next biggest section here is about taxes. And taxes will prevent a pretty fair amount of the test, because we will have an understanding about how taxation works, how investments are taxed, what things have certain tax advantages. All right, so in our tax system, our tax system takes the income we get and puts it into really three buckets, three categories. First category we're most familiar with is earned income, which is what you get from a job or running a business. So that's our earned income. And wages, salaries, tips, commissions, and bonuses is your earned income. Our tax system is a progressive tax system, which basically means a progressive tax, or income tax, I should say. Income tax is the more I make, the more I pay. So our tax system are going into tax brackets. Now, don't worry about memorizing tax brackets, okay? Okay, because I mean they potentially change every year, but the idea is we have a progressive tax system, and we're taxed based on we're going to do our taxes for the test based on our marginal tax bracket. The marginal tax bracket is the tax on the last dollar earned. Now, again, I'm just going to give you some examples. Do not use this as like, this is how it really is. I'm just making this up, okay? You don't have to know the numbers for the test. You just have to know the concept. But if someone's investment is anywhere from 0 to, let's say, $15,000, okay, they would be put in the 10% tax bracket. Sorry, 10% tax bracket. Okay, so, which is probably like the lowest tax bracket. If their income is between $15,000 to say 30,000, then there would be their tax. They'd be in a 15% tax bracket. Okay, and if they're for incomes 30,000 to 55,000, that would be like the 18% tax bracket, and from 55,000 to let's say like 80,000. Okay, that would be like the 22% tax bracket. Okay, and so on and so on. Okay, 80,000 to let's say 120,000. Okay, would be like the 25% tax bracket. Okay, again, don't take this as like any kind of like it's real numbers or anything. Just the idea, the concept. Okay. Now, by the way, that so it's the tax on the last dollar earned. So let's say someone makes $45,000. Well, that puts them into an 18% marginal tax bracket in our example here. So they pay tax, they pay 18% tax on the last dollar they earn. They're not paying 18% tax on their entire income. No, they pay 10% on the first 15,000, then 15% on 15 to 30, and then 18% from 30 up to their salary. So it's not tax, it's not 18% on their entire income. Okay, so that's one thing to know. Okay, so that's a progressive tax. So income, okay, income and estate taxes are progressive. Okay, now in case they ask you this, but there is such a thing as a regressive tax also. Okay, in a regressive tax, okay, all taxpayers pay the same rate. Okay, so everyone pays the same tax in a regressive tax. That would be things, for example, like sales tax, gas tax, cigarette tax. How do you spell cigarette? There it is, cigarette taxes. Okay, because you pay, right? You pay the tax based on the value, right? So whatever the tax is. They call them regressive taxes because they are a larger portion of a lower income earner's salary. Okay, so as a concept, I'll give you the idea of a regressive tax. Uh, a surgeon and an orderly both work at the same hospital. They both drive to work. They both put the same amount of gas in their cars to get to work. And they both pay the same amount of gas tax. However, the amount of gas tax is a much larger percentage of the orderly's salary than the surgeon's salary. So that's what makes it a regressive tax. So in our system, we have both progressive and regressive taxes. All right, and now say someone says a flat tax, okay, that's a regressive tax. All right, so that's bucket number one, right? The earned income. And things that are deductible against earned income, right, can reduce your reduce your earned income tax, right, reduce your taxes, things that are deductible against earned income. Another bucket is portfolio or investment income, and that's what you get from your investments, like from stocks, right, dividends from stocks, interest from bonds, capital gains. Okay. Now, depending on the type of portfolio or investment income, they have different taxes. Some things are taxed at a preferential rate. What is taxed at a preferential rate are two things. They first off are cash dividends on what's called qualified dividends, cash dividends on stocks or bonds. So let me write that. I'm going to call it qualified dividends because you have to hold the stocks for some time. And don't worry about how long it is. It's not that long. But you have to hold it for some time before you collect the dividends. So qualified dividends on stocks, and that's both common and preferred stocks. And also long-term capital gains. Capital gains are trading profits. So if you hold your investment for a certain period of time before you sell it, it's taxed at a lower rate. They call it a long-term capital gain. Does anybody remember, can you tell me how long you have to hold an investment before it's considered to be a long-term holding that gets a favorable tax rate? 12 months, 1 year, okay? All right. The best answer would be 12 months in a day, or a year and a day, or longer. If it was 12 months or 1 year exactly, they still consider that to be a short-term capital gain. Short-term capital gains are taxed as ordinary income. Let me put that here. Okay, let me write that out for you. Okay, short-term capital gains taxed as ordinary income. which means whatever tax bracket you fall into. Long-term capital gains, okay, they're taxed at a rate anywhere from 0%, 15%, or 20%. Most of us will fall in the 15% range. Now, who gets 0%? If someone's already in a 15% or lower tax bracket, then 15% is not favorable to them. It's not so special to them. For them, their tax rate is 0%. Long-term gains are taxed at 0%, tax-free. If someone's in the very highest tax bracket, I think, what is that, like 36 point something percent? I can't always remember that one, but like I said, don't worry about knowing it for the test. Just know how it works rather than the actual percentage numbers. If they're in the very highest tax bracket, then their long-term capital gain rate is 20%. I never really found out why. They give you a range. If you hold it for more than a year, it's a lower tax. What I think it is, and this is just my guess at it, but if you hold the investment for more than a year, they consider you to be an investor. And as an investor, they'll tax you at a lower rate. If you hold it for a year or less, then they consider you more like a trader. And as a trader, it's your regular business, right? To trade in and out of securities. So then becomes taxed as ordinary income. Okay. Now, things that are deductible, like portfolio investment deductions, are only deductible against your portfolio income. For example, capital losses, if you sell it for less than you paid for, are applied and offset against capital gains. So other things like if you have a safety deposit box to keep your stock certificates, that's deductible against your portfolio income. Right? If you pay margin interest on a margin loan, that's deductible against your portfolio income. So that's the idea where things are put into buckets, right? You have certain incomes, but the things that deduct against the things of that bucket, right? Of that type. Okay. So investors who get investors who receive interest or capital gains, right? They get a 1099 form from the broker dealer, which tells them, and it also tells the IRS what their income was, 1099 DIV from dividends that they received from stocks or from mutual fund distributions, and their 1099 INT tells us how much the interest they earn on bonds, on bank account deposits. Okay. All right, so it already mentions here in the slide, qualified dividends are taxed at a lower rate, the same as long-term capital gains rate. You have to hold the stock for some period of time before the ex-dividend date to be considered qualified. It's not that long, but just have to have it. It just basically says so you don't buy a stock, collect the dividend, sell it next day. Okay, okay. So ordinary dividends don't have that not considered qualified, taxes ordinary income. And 1099 INT, like it says, interest that are earned from bonds, debt securities, okay, and bank deposits. Our third bucket for income is passive income. Passive income comes from things like limited partnership shares, direct participation programs. Because as a limited partner in a partnership, you have no role in operations or maintenance of the business. You're basically kind of along for the ride as an investor. So they consider that passive income. You might get that from real estate, from royalties. Those might be considered passive income. So only your passive income losses can be used to offset passive income gains. So this is what they call here. So, okay. So the phrase that you're going to remember here is that PALs offset PIGs. Passive activity losses offset passive income gains. So if you hold some different limited partnerships, now remember, as limited partnerships, those are called pass-through entities, right? That means that you directly participate in profits or losses. If this partnership had gains, you're going to receive your share of your gains, but you also get your share of things that are business deductions, right? Things like, in real estate, you have things like depreciation, right? In oil and gas, you have things like depletion. Now, if the deductions are greater than the income, you actually end up with passive losses, which are deductible, but only against your passive income. You cannot apply your passive losses against your ordinary income because that's a different bucket. You used to be able to do that before 1988. Not anymore. Okay, that's when they put income into different buckets. Okay, so pals offset pigs. What if someone has more losses than they had gains and they can't deduct the rest? That's called a carry forward. So it's like an unused deduction. They couldn't apply it this year, but they take what they could not deduct this year and apply it next year to next year's gains. Okay, now I want to see if they have this. Just one second here. Yeah, okay, this is what I'm going to look for. All right, now when working out your capital gains and losses, this is a pretty big part of investments, of course. So what you have is cost basis. Cost basis is what you put into an investment, what you paid for it, plus commissions or sales charges, right? So those add them together, that's your cost basis. When you sell your investments, what you get from that minus commissions, right, is your sales proceeds. So to figure out how'd you do, you're going to take your sales proceeds, right? So sales proceeds minus cost basis equals your capital gain, hopefully, but potentially, of course, a capital loss. How would we figure this out? Well, let's see. So an investor buys 100 shares at $50 a share and pays, say, $50 commission. So what's the cost basis? 100 shares at $50 a share is a $5,000 investment plus the $50 in commission. So their total cost basis is now $5,050. And by the way, this has to be with after-tax money, right? You've already paid taxes before you put it into your investment. So you don't want to pay taxes again on the same money coming out. Only your growth is subject to tax. So that's why it's very important to keep track of cost basis, so you don't end up overpaying or underpaying your capital gain taxes. Okay, sales proceeds, of course, is what you get when you sell your investments. So we're going to sell 100 shares at $60 per share and pays, again, a $50 commission. So they receive $6,000 from the investment minus the $50 commission, and so their sales proceeds were $5,995. Sorry, $5,950. My apologies. Okay, so 5950. What? It helps if I could type. 5950 minus their $5,050 cost basis. If I'm getting this right, that should be a $900 capital gain. Okay, and if they held it for more than a year, will be taxed at a more favorable rate, at a lower rate. All right, so this is what I was looking for here. So now what if someone, okay, at the end of the year, investors will add up all their winning trades where they have a realized capital gain. And by the way, when I say a realized gain, that means they've sold their investments and got their profits. An unrealized gain, if someone bought an investment, it's gone up in value, but they haven't sold it yet. So that's called an unrealized gain. Those are just paper profits. And they're not subject to taxes because, well, you haven't had any profits yet. Only when you sell it are you taking your profits. All right, so what people will do at the end of the year, they'll add up all their winning trades where they have a realized capital gain. Then they add up all their losing trades where they show a capital loss and net them out against each other, right, in an unlimited fashion to figure out bottom line for the year. Did they end up with capital gains or capital losses? Net capital gains or losses for the year. So if they take their winning trades minus the losing trades, and if that's a positive number, they have a capital gain for the year, and they'll pay taxes on that gain. But if their losing trades were greater than their winning trades, then they have a capital loss, net capital loss for the year. Now, the capital gains are like unlimited taxable, so you might think that the losses might be unlimited deductible. Well, no. All right, this is again one of those buckets things. Okay, this is investment. Comes from investment income, and it's only offset against capital losses, offset capital gains. But only $3,000 of net capital losses can be applied to their ordinary income, bucket, or their earned income bucket, which is right this one here. Only $3,000 a year. So if someone had investments, if they lost $3,000, they can deduct that against their earned income and reduce their taxes. What if somebody had more than $3,000 of capital losses. Well, they'll deduct the first $3,000 from their ordinary income, and then whatever they could not deduct this year becomes an unused deduction, which carries forward to the next year. It is known as a capital loss carry forward, like an unused deduction that you couldn't apply. How might this work? All right, an investor shows $7,000 of capital losses, right? Bottom line for the year. The first $3,000 is deductible against their ordinary income. This leaves $4,000 to carry forward, an unused deduction that they couldn't apply this year, which they can then apply next year. So next year, they have this $4,000 unused deduction. So if they do show capital gains next year, let's say they have $8,000 capital gains the following year. So they can take that unused deduction, apply it against their gains, and just show $5,000 of taxable income. So they can reduce their taxes the following year. Or they can deduct next year, they can deduct another $3,000, okay, leaving $1,000 to carry forward to the following year. And in case you're wondering, is there any limit to the number of years they can carry forward? There is not. And there are probably people, so they can only deduct $3,000 a year. What if somebody had massive amounts of capital losses? Well, there are probably people who've been deducting $3,000 a year for decades. And by the way, that $3,000 capital loss deduction, that's never been inflation adjusted. So once upon a time, that might have added up to something, but not now. It's not that much. It's never adjusted for inflation. Okay, we've already talked about this. A couple of you have already told me, right? If you hold for 12 months or less, that's called a short-term capital gain. Tax as ordinary income, whatever tax bracket you fall into. If you hold it for 12 months and a day or longer, it's a long-term capital gain taxed at a preferential rate. They also call it the long-term capital gains rate. Okay, this is one of the more curious aspects, and this is takes a little bit of getting used to. It's called the wash sell rule. The wash sell rule says if you buy an investment and sell it at a loss, there has to be a losing trade, but you buy the same security or substantially the same security back again within 30 days of that losing trade, it becomes a wash sale, and the loss, which is normally deductible, the loss is currently disallowed. Notice I said currently, not completely. Now, also when I said it's 30 days from the losing trade, it's 30 days before, 30 days after, plus the trade date itself. So it's actually a total of 61 days. The wash sell window is a total of 61 days. So I just tell myself saying I don't wash windows for 30 days before or 30 days after. Okay. So what happens is that the loss, they cannot deduct the loss now. Instead, what happens is that the loss that was not deductible gets added to the cost basis of the second purchase, the one that caused the wash sell rule. No, okay, it's not on the second slide here. So let me give you an example. Okay, so someone buys a stock, buys at $50 and then sells at $45. So there was a $5 capital loss on this transaction. Normally that would be deductible, but within 30 days later, the person bought the same security or substantially the same again, let's say at $42. Now, since he bought it back within 30 days of that losing trade, the wash sell rule kicks in and that $5 loss is not deductible anymore. Instead, what happens, they take that $5 loss, okay, which is here, right? Take the $5 loss and add it to the cost basis of the second purchase, the one that kicked in the wash sell rule. So for tax purposes, they'll take the $5 deduction that they couldn't deduct, or the loss they couldn't deduct, add it to the cost basis, and treat it like he bought it at $47, not $42. So when he sells it again, let's say he sells it at, say, $54. Okay, so what is he going to report? He's going to report that he bought it for $47 and sold it for $54. So he's going to report a $7 gain. okay, rather than a $12 gain. So in reality, first was a $5 loss and then a $12 gain. But with the wash sell rule, they'll treat the first trade like a wash, right? Like a break even. And the second was a $7 gain. So bottom line, it still works out. It's just a matter of timing. So they can't really take the deduction until the second time they sell it. Now you say, well, I think it helps to know why there's a wash sell rule. Why do they go through all this effort? Because what used to happen before there was a wash sell rule, people would buy a stock, they'd buy an investment, and it would go down. So they'd be underwater on it. They'd sell it in December to show a tax loss for the year, and then buy it back again in January. So they weren't selling it to get rid of it. They were selling it to play a tax game. Wash sell rule says no more tax game. If you buy a security, sell it for a loss, buy it back for substantially the same thing again, back again, within 30 days of that sale, it's a wash sale and cannot be applied. Cannot be deducted now. It's basically postponed until the second sale. What do we mean when we say substantially the same security? Now, it could be the identical security, but it could also be things like a convertible security. Okay, like a convertible bond or preferred stock. Because, right, its value is going to depend on that, right? It could be a derivative instrument like rights, warrants, or call options, because its value is going to derive its value based on the underlying stock. So that's what we mean by substantially the same security. Now, frankly, I think that means if someone sells the Vanguard S&P 500 fund at a loss, and within 30 days buys the Dreyfus S&P 500 fund, personally, I think that's substantially the same security. They buy the same 500 stocks. I don't know if the IRS thinks so, but that's my thoughts on it anyway. Okay. Notice it also says the rules apply to spousal accounts and any account that they control. Okay, so that way they don't, okay, I'll sell it in my account for a loss, but I'll buy it in your account for a gain. Okay, and again, the idea is they're still trying to play tax games. Okay, here we go. Now, estate tax. Actually, tell you what, before we go on, we're half past the hour right now. Let's go ahead and take, oh no, I said, they're only three slides away. Let's continue. Estate and gift taxes. Okay, now an estate tax is paid when someone passes away, right? Someone's estate is a legal entity that holds the assets of someone who's passed away. And from there, it goes through probate often, and then, is distributed to that person's heirs. Now, the estate may pay taxes based on its value. So now there's an estate tax deduction, which, by the way, is a very high amount. Right? It's like, oh goodness, I saw it like 12 million. Actually, I can't even remember what the number is anymore. Notice how often I'm asked about it. So I never worry about remembering what those estate tax deductions are or phase out ranges because they potentially change every year. Just the concept is the first dollar amount, and it's a very large dollar amount, is not subject to estate tax. Anything over and above that can be. All right, now what they have is called the stepped up tax basis on an inheritance security. So someone receives securities as an inheritance. This has a stepped up basis, which means that the beneficiary's cost basis is going to be the value of the date the donor passed away, not the date that the donor purchased it. Now, this could be good for someone who's inherited this, right? Because if granddad bought shares of Standard Oil back in the 1960s, okay, and he receives it as an inheritance, well, Standard Oil then is ExxonMobil today. I think it's gone up in value at least a little bit. So when someone receives it as an inheritance, their cost basis, what they're assumed to have put into it, is going to be the value of the date the donor passed away. Because maybe they bought it, it's worth $10 now, and then now it's worth like $200 a share. $10 then, it's worth $200 a share now. So they're going to receive it as if they paid $200. So if the person then sells it for $205, they're going to show a $5 capital gain, right? Not a $195 capital gain. So as you see, that's going to be very beneficial. Also, whenever it's a inheritance, the gain is always considered a long-term gain, taxed at the favorable rate. Even if the person sells it the next day, right, it's still going to be considered a long-term capital gain, taxed at the lower rate. Now, it does say the estate is subject to estate taxes, whatever the estate holds. And things like life insurance, by the way, are part of the estate, so potentially can be subject to the estate tax. But it's the estate that pays the taxes, not the heirs. Now, what happens if someone gives securities as a gift? All right, now first off, any gift that's given can be subject to a gift tax, but there's an annual gift tax exclusion. Okay, now this one I do remember. The gift tax exclusion is $17,000 per person per year. So any gift that's given more than $17,000 to an individual per year can be subject to an estate tax, and it's the donor who's responsible for the tax. But it is $17,000 per person per year. So between the two of them, let's see, what would be? Okay, let's say grandma and grandpa together could give a gift of $34,000 per year to each grandchild every year, and still not be subject to an estate tax. More than that, they could be subject to a estate tax. All right, now when someone receives securities as a gift, now they didn't pay anything for that. Does that mean they show no cost basis? So if they sell it, it's like 100% taxable? Thankfully, no. The recipient's cost basis is going to be either the donor's own cost basis, what the donor paid for it, or the value as of the date it was given, whichever is lower, the lower of the two numbers. So if someone bought a stock, it was $20 a share, gives it to somebody else, and when he gives it to them, it's $22 a share. So the recipient's cost basis will be the donors in this case. They'll consider to have bought it at $20. If they sell for $22, they'll show a $2 capital gain. Okay. Now, by the way, will it be a long-term or short-term gain? The recipient gets the donor's holding period. So if someone bought a stock for more than a year ago, gave it as a gift, the recipient, it's a long-term holding for the recipient too. Even if they sell it the next day, it'll be treated as a long-term capital gain. All right, what about giving gifts to a charity? Giving securities to a charity, you can deduct the fair market value as long as they held it for more than a year. If they were less than a year, just the cost of the securities, what they paid for. Okay. All right, stock splits and reverse stock splits. I think we've had a chance to talk about that, haven't we? And I've showed you my formula for handling stock splits. Yeah, okay, Karina, I thought we did. Okay, so we don't have to get too much into this, but since we're talking about taxes, let's just put it this way. They got more shares of stock in a stock split, or they got less shares of stock. That is not a taxable event. Right? They didn't have to pay anything for those shares either. But they just received more shares. That itself is not a taxable event. It's not taxed until it's sold, when they realize a capital gain or capital loss. But on the split itself does not get a taxable event. But the cost basis per share, that gets adjusted, right, on a per share basis. So it says here, right, on a forward split, someone bought 100 shares at $50 a share. Okay, so their cost basis right now would be $50 a share. After a 2-for-1 split, though, they now have 200 shares at $25 a share. So their cost basis per share is now $25. And if someone sells it now for $27, they show a $2 per share capital gain. In a reverse split, basically the opposite happens, right? If they did have 200 shares at $25 a share, the company announces a 1-for-2 split. You get 1 share for every 2 that you had, 1/2 the number, twice the price. So now the basis is 100 shares at $50 per share. So the per share cost basis has been adjusted to 50. And if they sell it now for $52, again, they'll show a $2 share capital gain. Okay. On mutual funds. All right. As a mutual fund investor, you're entitled to your share of the earnings and profits that the investments in the mutual fund generate. Right? So if the stock gets earnings from interest or dividends, you get your share passed along to you. If the mutual fund manager bought and sold investments for a profit, okay, you get your share of the capital gains. That's a capital gain distribution. Your key word, distribution, tells you it came from a mutual fund, right? Not from them selling their own shares. It came from basically their share of the trading profits that the fund had. Okay, now here's the deal with this one. Are they long-term or short-term based on the fund's holding? How long did the mutual fund hold the investment before selling it for a profit? If the mutual fund held an investment for more than a year, that shareholders get their share of those profits as a long-term capital gain distribution taxed at the lower rate. If the fund held it for a year or less, each investor gets their share of profits as a short-term capital gain distribution taxed as ordinary income. The way they try and trick you is they'll tell you someone bought a mutual fund 3 months ago and got a capital gain distribution. What's the tax on it? In this case, the fact that he bought it 3 months ago doesn't matter. It's irrelevant. It's the fund's holding period. So it would be a long-term capital gain distribution taxed at the lower rate. Doesn't matter that he bought it 3 months ago. Now, if the test question says someone bought a mutual fund 3 months ago, and then the investors sold their own shares for a capital gain, I didn't say distribution. Notice I did not say distribution. Then this investor is showing a short-term capital gain, taxes ordinary income. Okay. Now, the thing with the mutual funds do not distribute capital losses. What if the mutual fund had losses for the year instead of gains? There is no such thing as a capital loss distribution that you can take as a deduction. That doesn't exist. All right. Now, when it comes to the dividend distributions, right, that's their share of the income that the earnings investment gets paid out to investors. The mutual fund is like a money funnel, right? Taking money from the source, travels through the mutual fund, gets paid out to each investor. They call that pipeline theory or a conduit theory. The fund is just basically passing money along. Whatever type of the tax the source of the money has, the dividend distribution has the same type of tax. A corporate bond fund, for example, corporate bond interest is taxed as ordinary income, so the dividend distribution of a corporate bond fund is taxed as ordinary income. But a municipal bond fund, the interest income on muni bonds is federal tax exempt. Therefore, the dividend distribution of a muni bond fund is federal tax exempt too. The fund is just passing the money along. Here's the thing also, since it mentions here, a municipal bond fund can generate capital gains. If the fund manager buys a municipal bond and sells the bond for more than the fund paid for it, the fund shows a capital gain. Each investor gets their shares as a capital gain distribution, and capital gains are taxable. It may be taxed at a lower rate if it's long term, but it's still taxable, right? It's only the dividend distribution, which comes from the muni bond interest. That's the part that's tax exempt. Notice it says also a value of the fund may decline, but shareholders can still get capital gains if the fund sells securities for a profit. I remember hearing of like some things on the news where people were grumbling. Oh, it was a bear market, the market fell, but my investments fell, but I still got a capital gain distribution I have to pay taxes on. All right, tell them to read a book about how mutual funds work. Okay, mutual fund exchanges sell my Fidelity Growth Fund and use the money to buy the Fidelity Balance Fund. The IRS still looks at that as a realized capital gain, subject to capital gains or losses that year, realized that year, can be long-term or short-term. And then the purchase of another investment, which establishes a new cost basis and a new holding period, right? It becomes a short-term holding until a year has gone by. Okay, that is our regular lecture stuff on this. So let's go ahead and take a break. And when we come back, what we're going to do is we're going to do a final exam. So log into your Past Perfect and pick a final exam, 85 question final exam, and we'll go through that through the test as a proctored exam. Remember, proctored means monitored, and monitored means Big Brother is watching you. So I will be monitoring, and you'll be taking the exam. Okay, so we'll just work in silence for a while, and when you're ready to go, okay, feel free. If you want to send me a quick text message, don't talk out loud now because don't unmute because you might startle somebody all of a sudden if they've been concentrating. So let's return at 50 past the hour. Okay, and then we'll take our practice exam. All right, we'll see you shortly. Sorry? How long do you break? 10 minutes. Going back to work? Yeah. Yeah. I just sat down a lot of it. Um, cheese manicotti with marinara, with roasted potatoes and capri vegetables. Welcome back from break. Okay, and if I can confirm, okay, thank you, Karina, Hannah, Ashley. All right, appreciate it. Okay, I think you already knew where I was heading with that. Okay. All right. Well, with that, that's okay. If you're ready, go ahead and log into Past Perfect and pull up a final exam, an 85 question final exam. Okay. Are you already done so? Are you already ready to go, or is there anyone who needs a moment or two to set that up? Oh, question here, is it the randomized one, or will you choose 1 through 10? Go ahead and choose a 1 through 10, and one that you have, if you've already started taking finals, one that you haven't taken yet. Okay. Please let me know when you're ready. Is there anybody who's not ready? Okay, because Ashley has said yes, but anybody else? Because that's the only one. Okay, Hannah's a thumbs up, so is Amy, Alexis. Okay, who else? Not the mastery exam. No, not the mastery exam. Correct. Not mastery 4. No. Okay. Colby, Kimberly. Colby's a thumbs up. Okay. Um, Kimberly's ready. Alicia. Hannah, are you ready to go? I don't remember if you told me or not. So, okay. I believe everybody's ready. So if you are ready to start, then we're going to start in. Oh, and by the way, when you're done, you're ready to head out. If you have any comments, questions, anything you need, type a message in. This time I would not suggest unmute. What you may also consider doing, again, is turn on your video. I'll turn mine off to really simulate what a proctored exam is like. So just so that you're used to it. Because when the exam is proctored, they're watching you. Okay, right? Because they're very serious about making sure about the integrity of the test. All right, so you may consider that just as an idea to get used to the concept. All right, but if you're ready to go, if everybody's ready, we will start in 5, 4, 3, 2, 1, and go. Okay, so I'll still be here, and if you need to get my attention, go ahead, type a message in the chat, and you can head out when you're done.